Hello, welcome once again to this channel. If you are new in this channel, kindly consider subscribing, consider liking the videos, share and comment. Our lesson 6 is talking about statement of financial position, or the one that we always know as the balance sheet. What is the statement of financial position? This refers to a statement which provides a comprehensive picture of an organization's financial position as at a particular date. It is one of the financial statements of an organization which reports an organization's assets, liabilities, and capital at a specific point in time. It is a financial report of an organization which gives a picture of the status of finances of an organization at a particular point in time. The other description that is given in terms of the contents of that statement. It displays the summary reports on assets, liabilities, and equity or capital at a particular date. The statement of financial position can be prepared in two different orders, namely the order of liquidity and order of permanency. When we talk about order of liquidity, what we are trying to say here is that the contents of this statement will be arranged in such a way that the items that can be easily changed into cash are the ones to start. Then we go down to the one that will really take much time for it to be changed or for it to be converted into cash and cash equivalents. If I can give an example in that circumstance, if you are having under the category of current assets, for example, you are having cash at hand, you are having cash at bank, and you also have stock and let's say debtors. You start with cash at hand, cash at bank, then stock. Why am I saying stock? You know, it's very easy to sell stock than to receive the debt from your customer. Based on the prudence concept, you know, accountants are normally not very optimistic of the future. So the debt that somebody is owing you, it's very difficult to recover it as compared to what you have in hand that you can be able to sell in cash. So we would say that using the order of liquidity, we'll start by cash at hand, cash at bank, then we go to stock, then we go to debtors. Okay, when we say that a firm is liquid, it means that a firm has got money at hand to take care of its operations expenses as they fall due. So you look at the ones that you can quickly be able to change into cash, the ones that you can be able to convert into cash, so that the organization can be able to settle its present obligation as soon as possible. So those are the ones that you consider to be much more liquid than the other ones. That is the order of liquidity. Now, when we want to talk about the order of permanency, it is exactly the opposite of that. We arrange the items in the balance sheet based on the ability to last in the organization for much more longer period as compared to others. If you have got a present obligation which you expect to settle within a period not more than 12 months, then you would consider that to be less permanent as compared to that which you need to settle within a period more than 12 months. So if you are going for the order of permanency, I said it is the exact opposite of the order of liquidity. The most common method that is normally being used, even in the organizations in making the financial statements, it is the order of permanency. Allow me to take you through the format of a balance sheet. We are going to use the advanced format of a balance sheet. We are not going to use the T account, but still, I would tell you that if you want to use the T account, you will just ensure that assets are arranged on one side, then on the left-hand side, which is the debit side, then arrange all your liabilities and capital on the right-hand side, which is the credit side of the T account. In this format, we are going to have assets, then we compare with the liabilities and capital. Then we should be able to find total amounts that are matching. The total assets figure should be equivalent to the total liability plus capital added together. If you look at the arrangement that we are having, just like we had mentioned, without forgetting, just like we had mentioned in the previous one, we were saying that These statements, first of all, you have to describe what they are. You have to give us the name of the organization for which you make these statements. So in this case, you can see we are having Bestie Traders Limited. And then you have to follow it by defining or giving us the name of the financial statement that you are talking about. Then the third thing is that you have to talk about the period for which the statement relates. You can see we are having Besties Traders. We have statement of financial position as at 31st March 2020. A point to note, you will realize that when we were preparing the statement of financial performance, we said for the period ended, but now we are saying as at 31st March 2020. The other one for income statement was for the period ended 31st March 2020. So the difference is we had mentioned that the balance sheet is a statement which gives us the picture of financial position as at a particular date. That's why we are using the phrase as at. So always ensure that when you are preparing your financial statement, that is the balance sheet, then you have to use as at where it is required, and you use for the period where it is required. Now you can see the items that we are having under assets. We have non-current assets, and then we go to current assets. We are tending to go as per the order of permanency, because you can see we have land, buildings, equipment, vehicle, furniture, investments, intangible assets, biological assets, and what have you. Now then we have current assets. Under current assets, we have accounts receivable, prepaid expenses, inventory, stationaries, bank, and cash. Now, I'll have a better time to look at the prepaid expenses because I don't want to concentrate on something different in this particular lesson. So we'll create another time to explain what we call the accruals and the prepayments. After you shall have done the assets, then what comes next is the liabilities. Now you go to the liabilities, which you also arrange in terms of the non-current liabilities and the current liabilities. Then after that, you are supposed to have the capital. We have got items that affect the capital base. The additional investment will increase the capital base. The profit will also increase the capital base. Then the drawings that are done by the owner of the business will reduce the capital base. So that is going to be our format. We are going to use this question of Abdul Anan to handle the last bit which was left. And we had gone through it, so there is no need to reread it again. We had done that in our lesson 5. You are required to prepare trading profit and loss account and balance sheet as at 31st December 2019. We had already done the statement of financial performance, and we ended up with a profit, which is here. This is the profit that we got. So this one is also going to be used to increase the capital base the way I was explaining. Allow me to move to the calculation of the balance sheet. Yeah, we are going to have some few workings here and there so that we can be able to complete the transactions, and then we develop what we call the statement of financial position. So you remember there are some adjustments that we had here. They were meant to affect the income statement as well as the balance sheet. I want us to complete the transactions. The one that we did last time, you can do that one in case you've been asked to prepare the income statement only. Then from this point, this is what you will be using in case you've been asked to prepare the income statement and the balance sheet. So this one now brings you to a completion of the workings. These are the workings that we did. So we want to complete on the items that we left to use in the balance sheet. Number 1 is the provision for doubtful debts. This one was to affect our debtors account. We also have provision for depreciation on furniture account. That one will affect the furniture amount. There is provision for depreciation on machinery. That one will also affect the value of machinery that we are closing with. And then remember we were having accounts receivable. So these ones are the items that we'll move with to the statement of financial position. I want us to bring in the machinery account and the furniture account and see how they are being affected before we pick their last figures to the financial position. Now here we'll be having machinery account, which is an asset, debit and credit. So here is furniture account, Now we have to start with the balance brought down so that we adjust them. Every time you want to adjust any ledger account, first of all, you have to pick the balance brought down. Then you make the additional entries. So the balances brought down were on the debit side. Now I'll pick, for machinery account, we have balance brought down. The balance brought down here for machinery account is, we have 24,000. So you'll be using 24,000 here. Then for furniture, we also have balance brought down of furniture is here, 3,500. 3,500. Remember, all these are in dollars. All of them are in dollars. Always remember to keep that one in mind. I want to close down the provisions for depreciation accounts into the machinery account and the furniture account. So now we take the one that talks about the provision. So this one, remember, we are having the balance brought down here. So this balance brought down, I can still pass another entry so that I remove this amount from here. So I'll say here, because it is on the other hand, I'll just come here and say machinery account 2,400. I'm picking that amount, then taking it to machinery account. So because that one we debited it on this account, now we are going to credit the machinery account. So we say here, we'll be saying here provision for depreciation on machinery account, which is 2,400. So as you can see, this account is now closed at this point because they are equal. 2,400, 2,400. We do not have any variance. So you close it at that point. Then we also have another provision for depreciation on furniture. So this one I'll also come and close it here saying furniture account 350. $350. Now you come to the furniture account and credit provision for depreciation on furniture, $350. $350. Now when you come to this account, you'll realize now we have 350, which will close down with a zero variance. So that is how we close the accounts. So you'll realize that we are now done with the provision account. We are done with all the provisions accounts. So what is left here is the provision for doubtful debts, which we'll use, instead of using this one to reduce the debtors amount under current assets, I'll display that one under the category of current liabilities. Another person would also still use this one to reduce the current assets, which is the debtors. That one still is allowed. So whichever method that you use, I said that in accounts we have got several ways of handling accounts, and that is what is making it more interesting and much more easier. The name here was Abdul Hanan and Company. Abdul Hanan and and Company Limited. Abdul Hanan and Company Limited. Which statement is this? Statement of financial position. We are talking about the period. We said statement of financial position is as at. So as at 31st December 2019. So these are the columns that you are going to use. We have two columns. This inner column we'll be using when we want to do some adjustments. So I'll be starting here with assets. Assets. Under assets we have non-current assets. Non-current assets. Non-current assets. Now we want to start picking the items. There's something here that we have not concluded on. Kindly remember to close down these accounts. So you need to come here and check. The total here is 24,000 and the other one is 2,400. The other one is 2,400. So if you pick 24,000, because that is the highest, minus 2,400, you get 21,600. So this side should be adjusted. Balance carried down 21,600. So here we have $24,000. Now we have closing on the other side. We have balance brought down on this side, which is 21,600. So this is the balance that we'll take to the balance sheet. This other side you also need to adjust balance carried down. So here we have 3150. You can close this one. Can close this one at 3,500, 3,500. But then the balance brought down should be $3,150. So these are the figures that you will pick to the balance sheet. Looking at the trial balance that we were given here, we can be able to identify the kind of assets that will be more permanent in the business. We have equipment, motorcar, furniture, and we have machinery. Those are the items that we expect to take more than one financial period. So those are the items under the category of non-current assets. And again, we want to check the one that can take much more time in the organization than the rest. Furniture, motorcar, equipment, and machinery. Using this question, I think machinery becomes much more permanent. Machinery. And in case you are taking machinery, we'll not pick, when you are taking machinery, we are not going to pick the amount that is here because it has already been affected by the adjustment. So we pick the amount that is captured under the ledger account for adjustments. We are going to pick 21,600. So here, take 21,600. We are putting it here to give us room to sum, and then we put to the last column. Then the next thing, we are already done with the machinery. Then furniture, I think, should come later. We can have equipment. Let us have equipment here. We can have equipment. So equipment, we did not tamper with equipment, so it is 2,508. 2,508. We are done with equipment. We are done with machinery. The next item that we need to pick is motorcar. We did not tamper with motorcar. Motorcar, can also be picked at the same amount, which is 22,000. We pick motor car at 22,000. Then we go for furniture. Furniture, we had done some adjustments, so we pick the one that was adjusted, which is 3,150. So we can have here furniture 3,150. So we are done with furniture, and we are done with the machinery, equipment, and motor car. So those are the items that fall under the category of non-current assets. Once you are done with that, we can move to just put a line here, then bring the totals here. So the amount is 49,258. 49,258 dollars. We go to the category of current assets. Current assets. On the calculations that we did, we have got accounts receivable. Receiving from customers at times becomes not so promising as such based on the prudence concept. So sundry debtors and the accounts receivable can go together. But then we also have cash at bank, we have cash at hand, and also we have stock here. Now we can start with the accounts receivable. So we can start here and say we have accounts receivable. Now accounts receivable, the amount is 3,600. So you can also have here 3,600. Accounts receivable, then we go to sundry debtors. So the sundry debtors will be picking 52,000. Under sundry debtors we have here 52,000. So we'll do 52,000. After that, then we pick the closing stock. So we can say inventory $35,000. Then the other item here is cash at bank. So we can put here cash at bank. Cash at bank. Cash at bank is 6,200. So we do here 6,200. Then we go to cash at hand. Cash at hand. Cash at hand here we have 2392. 2392. We are done with the category of assets. So we can just put a line. We can just put a line here and then give the totals. The total here that we have, we are getting a total of 99,192. Then you can get the total assets. 148,450. $148,450. So that is what you have as total assets. So you can write here total assets. It is always advisable to pay out your creditors, the liabilities, before you pay the owners of the business. Because you cannot pay the owners then you leave your creditors hanging. So then that means the capital will stay in the business up to the point that liabilities are all settled. That is when we'll be closing down the business by paying the owners of the business. So in short, what I'm trying to say is that capital seems to be more permanent as compared to liability. So following the order of permanency, then capital becomes the first one. So we'll be having here capital. Now under capital, we have the first value that was given for the owner equity, which is 20,000. So here you can have a line and say owner's equity. Owner's equity, which is 20,000. And then we want to check the items that will be affecting the owner's equity. You can see there is drawings here. So this one will always reduce the capital base. So you will say here less drawings. Drawings amounting to 8,000. And you put that in bracket to show that it is being deducted. Here, we need to add the profit that we got, because that one will increase the capital base. Profit. Remember, our profit was in the statement of financial performance. So we pick this value, which is 111,850. So we add that one there. Then we can add the 3 and bring the totals here, giving us a total amount of 123,850. So here is 123,850. Now we need to go to liabilities. 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 If the liabilities are not there, you don't need to write it here. So we only put what is there. So under liabilities, let's see what we have. We only have accounts payable. And under our calculations, we also left one liability that we said we would add there, which is provision for doubtful debts. Provision for doubtful debts. So those ones are current liabilities, and therefore we'll be having the category of current liabilities. So here, just say, because we do not have non-current liabilities, so we just have current liabilities. We have accounts payables, which is 22,000, and then we have provision for doubtful debts. So right here, accounts payables. Accounts payables, and the amount here is 22,000. So just come and put 22,000 here. Then the other item is provision for doubtful debts. Provision for doubtful debts, and that one will be, the amount is 2,600. So that is what we are having under that category, and then you just put a line, then get the total. This one will be 24,600. So we can get the total liabilities and capital combined together. The answer here is also 148,450. If you look at the amount that we are having here, 148,450, and this one, they are matching. So that is how we check if the balance sheet is balancing. So the total here is described as capital and liabilities. Liabilities. So this is the statement of financial position. This is our statement of financial position, and you can see it is balancing at $148,450. You can also use these concepts to try and do some questions that are within your disposal. And in case of any query, then you can always put a comment at the comment section there so that we can also check it together with you. Otherwise, thank you so much, guys, for taking your time to listen to me. And I just want to also remind you once again that you need to subscribe to this channel before you leave. I wish you all the best. Until another time, I know we are going to meet in our 7th lesson where we shall be discussing about the depreciation methods. Thank you so much. Until another time, my name is CP Otieno. Thank you.